Hello, I'm Thorsten Beck. I'm the director of the Florence School of Banking and Finance, and today I want to discuss with you the effects of the new European supervisory architecture on countries outside the European Union. The new European architecture of supervision and resolution has had effects not only on countries that are members of the banking union itself, but also outside it. Let's take the example of many smaller countries in Central, South and Southeastern Europe. Many of these financial systems are dominated by subsidiaries of large Western European banks, such as Société Générale or UniCredit, where before the parent banks of these subsidiaries were supervised by national supervisors, Banca d'Italia, Banque de France. It is now the single supervisory mechanism in Frankfurt, which is the responsible home country supervisor. At the core of the problem I would like to discuss is an asymmetry. On the one hand, the subsidiaries have important, if not market-dominating roles in these small countries. On the other hand, the operation of these banks in the host country is a minuscule part of the overall balance sheet of the parent bank. Take the example of Banca Intesa San Paolo in the Slovak Republic. The market share of Intesa San Paolo in Slovakia was 19% in 2006, a fifth of the overall banking market. While the share of this specific subsidiary in Intesa San Paolo's total assets was 0.3%. For that reason, for home supervisors, these subsidiaries are not really important, and they might therefore be reluctant to include small host country supervisors in the College of Supervisors. For host country supervisors, on the other hand, these subsidiaries might be systemically important institutions for their banking system. If not enough cooperation is forthcoming from the home country supervisors, they might be tempted to focus on the resilience of the subsidiary as stand-alone entity, undertaking what is often referred to as ring fencing. The new European framework has different implications for these small host countries within the banking union, within the EU but outside the banking union, and outside the EU. So, first, let's focus on the countries that are within the banking union itself, such as, for example, the Slovak Republic I just mentioned. The implementation of the banking union has resulted in the elimination of this traditional home-host distinction, Banca d'Italia with the supervisor in the Slovak Republic, for example, because the single supervisory mechanism is now both home and host country supervisor is responsible for both the parent bank and the subsidiaries. Local supervisors still participate in the supervision or possibly resolution, but they are now as part of the joint supervisory team or of the resolution teams. Contrary to the banking union hosts, non-banking union but EU member states, think about the Czech Republic, retain their full competence as individual or sub-consolidated host supervisors and resolution authorities. However, they are now bound by new rules on supervision and resolution on the level of the European Union. They have the right to participate in supervisory and resolution colleges that, for example, the SSM might establish. They have also the right to gain access to critical information on the consolidated level about their subsidiaries in their own countries. At the same time, dealing with just one supranational authority, such as the SSM, as home country supervisor rather than several national ones can be actually an advantage. However, a common concern for these small host countries that are within the EU but outside the banking union might be that the SSM doesn't pay enough attention to systemically important subsidiaries in the host country because, again, they're simply not important enough in the context of the overall operation of the parent bank. Now let's turn to our third group, which are small countries outside the European Union. Think about Montenegro, for example, or Albania. The rights and obligations of these non-EU countries are very different from that of EU countries. They can be invited as observers to join supervisory and resolution colleges, but they have no rights to be invited. And their participation is conditional on an equivalence assessment by the European Banking Authority and by the agreement of other college members. The centralization of supervision within the banking union might actually have pushed these non-EU supervisors even further to the sideline. So some of these non-EU host supervisors have observed that the colleges currently organized by national supervisors within the Euro have a much higher level of engagement with non-EU hosts than the colleges that are directly organized by the single supervisory mechanism in Frankfurt. In summary, there seems to be somewhat of a cliff between EU members and non-EU members in terms of engagement with small host country supervisors. For the benefits of these non-EU host countries, and given the importance that the subsidiaries of these large Western European banks have in these systems, a stronger engagement by the banking union institution is really called for.